He isn't a politician. He doesn't lead a country. Yet when markets shake, presidents call him first. His company moves money faster than governments can print it. He oversees more wealth than most nations combined, and yet, most people have never even heard his name. Larry Fink controls $10 trillion, and through it, he has quietly reshaped the global economy. This isn't a story about a man who built a company. It's about how he built a system that touches your savings, your rent, your job, your future. And the most extraordinary part, you never voted for him. You probably don't even know what his company does, but it's everywhere. For centuries, power came from land, law, and armies. Kings ruled by conquest, presidents ruled by policy. But the 21st century created a new kind of power, invisible, unaccountable, and global. Not political power, not military power, financial power. Power built on information, algorithms, and ownership. And no one represents that transformation more completely than Larry Fink, the man who turned a small risk management startup into the single most influential financial force on Earth, BlackRock. Today, BlackRock manages more than $10 trillion in assets, around 1/8 of all the money invested on the planet. That's more than the GDP of Japan, Germany, and India combined. Through index funds, ETFs, and global portfolios, it owns pieces of nearly every major company in existence: Apple, Amazon, Google, ExxonMobil, Pfizer, Microsoft, and hundreds more. Every time you use a product, drive a car, or pay rent, a fraction of your money flows through BlackRock's vast network of funds. It's not a conspiracy, it's a mathematical reality. If you invest in the market, you are, in some small way, invested in Larry Fink's empire. But Fink's story didn't begin in a boardroom. It began in chaos. In the late 1970s, New York's financial district was a jungle. Smoke-filled trading floors, chalkboards full of numbers, brokers screaming orders until their voices cracked. The economy was shaky, inflation out of control, and trust in Wall Street low. Amid that chaos was a young trader named Larry Fink. Fresh out of UCLA, he joined a respected bank called First Boston, and almost immediately, he started changing the game. Fink specialized in bonds, specifically in something new and complicated called mortgage-backed securities. The idea was simple in theory, but revolutionary in practice. Bundle thousands of home loans into a single bond, then sell that bond to investors. It worked brilliantly. The system created liquidity, which meant banks could issue more loans, which meant more people could buy homes. The American dream, powered by data. For a few years, Fink was unstoppable. His desk made hundreds of millions. He became a star on Wall Street, a man whose models could predict the future of the bond market. Until one day, they didn't. In 1986, interest rates rose unexpectedly. That small change rippled through Fink's mortgage bonds like an earthquake. Within days, his portfolio lost $100 million. On Wall Street, that kind of mistake doesn't just cost money, it costs reputations. For Fink, it was a personal collapse, but it also revealed something vital. The problem wasn't the market. It was that no one truly understood the risk they were taking. Everyone was guessing. Everyone was flying blind. He made himself a promise. If he ever built his own company, it would be based on information, not intuition. In 1988, Larry Fink gathered 7 partners and founded a small firm in Manhattan called BlackRock. They had little money, a few computers, and one radical idea: to build the most sophisticated risk management system in finance. While other firms chased short-term profits, Fink built a culture obsessed with transparency, data, and discipline. The goal wasn't to gamble, it was to measure everything, every client, every trade, every market scenario. To do that, Fink needed technology no one else had. So his team began building a software system unlike anything in existence. A system that could simulate the global economy in real time, calculate risk down to the smallest fraction, and predict how different events, wars, rate hikes, pandemics, might affect every portfolio on Earth. They called it Aladdin. Aladdin wasn't just software, it was a nervous system for finance. It pulled data from thousands of sources, analyzed trillions in assets, and ran millions of stress tests daily. It could show how one company's bankruptcy might ripple across markets, or how a new law in Europe might affect oil prices in Texas. By the mid-1990s, Aladdin was so advanced that other institutions, banks, insurers, even governments, begged to use it. Fink realized what he'd created wasn't just a tool, it was leverage. He began licensing Aladdin to other financial giants, turning competitors into clients. By 2000, the system was monitoring over $11 trillion worth of assets, and not all of them belonged to BlackRock. Aladdin made money, but more importantly, it made visibility. It allowed BlackRock to see what almost no one else could, how money flowed across the world in real time. In a market built on uncertainty, that made Fink's firm indispensable. As technology advanced, so did the idea of investing itself. For decades, Wall Street had operated on one principle: beat the market. Fund managers tried to find hidden gems, make bold bets, and charge clients high fees for their expertise. But study after study proved the same thing. Most of them couldn't beat the market consistently. So investors began to ask a radical question. What if we stopped trying? The answer was index investing, the strategy of simply buying the entire market instead of trying to predict it. Instead of choosing 50 stocks, you buy the S&P 500. You don't pay for genius, you pay for efficiency. And when computers came along to automate the process, that efficiency became unstoppable. In 2009, in the aftermath of the global financial crisis, BlackRock made the move that changed everything. It bought Barclays Global Investors, the firm behind iShares, a massive network of low-cost exchange-traded funds, or ETFs. Overnight, BlackRock became the world's largest asset manager, the king of passive investing. The timing couldn't have been better. After 2008, ordinary investors no longer trusted the banks or their high-flying fund managers. They wanted simplicity, they wanted safety, they wanted transparency. BlackRock offered all three. Money began flooding in. Billions turned into hundreds of billions, hundreds into trillions. The growth was exponential. And because index funds buy pieces of nearly every major company, BlackRock's ownership became woven into the DNA of capitalism itself. But this model had an unintended side effect: power. When you own part of every major company, you get to vote in their shareholder meetings. You help decide who sits on boards, how executives are paid, and whether companies go green or drill for oil. In other words, passive investing created active influence. Every January, Larry Fink writes a letter addressed to the CEOs of the world's largest corporations. It's not an order, but it might as well be. In his letters, he talks about the future of capitalism, about how companies must care for the environment, treat employees well, and plan for long-term sustainability. He calls it stakeholder capitalism. To some, Fink is a visionary, a capitalist who believes profit and purpose can coexist. To others, he's an unelected power broker using other people's money to enforce his personal philosophy. But whether you agree or not, one thing is undeniable. When the world's largest shareholder expects something, companies listen. BlackRock's ownership gives it voting rights across thousands of firms, from oil giants to tech startups. And while Fink insists those votes represent his clients, not himself, critics say that distinction is meaningless when one firm's opinion can shift entire industries. Still, the world kept giving him more money. Because BlackRock's system worked, then came the crisis that changed everything. Again. In 2008, the global financial system collapsed under the weight of bad debt and blind risk. Banks failed, credit froze, and panic spread. Governments didn't know what to do. But Larry Fink did. BlackRock's technology could see the damage in real time. Its data showed which institutions were collapsing and which could be saved. The U.S. Treasury and the Federal Reserve turned to Fink's firm for help managing hundreds of billions in toxic assets. Overnight, a private company became an unofficial arm of government. BlackRock didn't just manage portfolios anymore. It helped design policy. It analyzed failing banks, valued distressed assets, and advised the same agencies responsible for regulating the system. It was the moment BlackRock became too useful to ignore and too big to challenge. A decade later, when COVID-19 froze the global economy again, the Federal Reserve came back to the same address. They hired BlackRock to help stabilize bond markets and distribute emergency liquidity. Everything was legal. Everything was disclosed. But it revealed a new reality. When crises hit, governments call Larry Fink. And that raises a question few people dare to ask. If one private company is both an advisor to governments and a shareholder in the corporations those governments regulate, where does public power end and private influence begin? Because by now, BlackRock wasn't just part of the system. It was the system. But the story doesn't end with money. It's about what happens next. When one firm's reach extends beyond markets into governments, housing, energy, and politics. Because Larry Fink didn't just build a financial empire. He built a new kind of power, silent, systemic, and everywhere at once. And that's where the next chapter begins. The deeper BlackRock expanded, the less it looked like an investment firm, and the more it resembled infrastructure, an invisible operating system for capitalism itself. Its software, Aladdin, now tracked risk for hundreds of financial institutions, from hedge funds to pension systems to central banks. On an average day, it processed tens of millions of simulations, scanning every possible market outcome in milliseconds. If the world's economy had a heartbeat, Aladdin was listening to it. That listening power came with something else: visibility. Fink could see where capital was flowing, which industries were rising, which were dying, which governments were quietly shifting policy. It wasn't espionage, it was analytics. But in the information age, analytics is influence. Whoever understands the system first controls how everyone else reacts. Governments began noticing. When European debt threatened to tear apart the Eurozone, regulators called on BlackRock to assess risk. When Latin American markets wobbled, finance ministers asked Fink's team for guidance. The firm that once measured risk for clients now measured risk for countries. No vote, no campaign, no speech, just numbers. And in the modern world, numbers decide everything. Inside BlackRock's headquarters in Midtown Manhattan, the tone was clinical. Walls of screens displayed live data streams from every major market on Earth. Aladdin's dashboards pulsed with green and red. Analysts didn't talk in emotions, they talked in probabilities. If politics was about beliefs, finance was about precision, and precision was Larry Fink's language. But precision couldn't hide the moral fog that followed success. As BlackRock's ownership spread, so did criticism. In real estate, its funds bought thousands of homes during the post-2008 housing recovery. To Fink, it was a logical investment. Housing demand was stable, returns consistent. To communities, it looked different. Wall Street landlords bidding against families. For the first time, Fink's empire had a face, and it wasn't friendly. BlackRock defended itself by saying it owned less than 1% of U.S. housing stock. True, but scale isn't just numbers, it's perception. When a company that manages $10 trillion enters your neighborhood, it feels like a storm front. Local or not, it changes the weather. Fink didn't flinch. He doubled down on his philosophy: long-term vision, data-driven decisions, sustainable growth. He believed the same analytical discipline that governed markets could improve society. That conviction birthed BlackRock's most controversial idea: ESG investing. ESG stood for environmental, social, and governance factors. The concept was simple: companies that respect the planet and their workers will outperform those that don ET. In practice, it was revolutionary. BlackRock began encouraging firms to disclose carbon footprints, diversify boards, and plan for a low-carbon future. It wasn't regulation, it was persuasion, backed by ownership. The reaction was explosive. To supporters, Fink had become the conscience of capitalism. To critics, he was its self-appointed king. Politicians on the left accused him of greenwashing, pretending to care about climate while still funding oil giants. Politicians on the right accused him of weaponizing finance to push liberal agendas. Some states even pulled their pension funds from BlackRock in protest. Fink saw the outrage as proof that he was walking the narrow line between profit and purpose. He reminded investors that his job wasn't activism, it was stewardship. In his view, ESG wasn't politics, it was pragmatism. Climate risk, he argued, is financial risk. Ignoring it would be bad business. Still, the debate changed BlackRock's image. It was no longer invisible. It was everywhere, in headlines, hearings, and hashtags. The company that once prided itself on quiet efficiency was now a symbol in a cultural war over who really runs capitalism. Behind the noise, the machine kept humming. Money poured into ETFs, 401ks, and sovereign funds. BlackRock's profits soared. Its employees grew to more than 20,000 worldwide, spread across 70 offices in 30 countries. The firm managed infrastructure in Europe, technology in Asia, and energy pipelines in North America. If globalization had a fund manager, it was BlackRock. Yet the more global the company became, the more fragile the system it operated within seemed to grow. By 2020, Fink was warning of a world entering a period of fragmentation. The long era of interconnected markets was fracturing under the weight of nationalism, climate shocks, and digital disruption. To survive, he said, economies would need stronger partnerships between governments and corporations. To his critics, that sounded like the opposite of democracy. The truth sat somewhere between fear and function. Modern finance had evolved into a web of mutual dependence. Governments relied on BlackRock's technology to understand markets. Markets relied on governments to guarantee stability. And the ordinary investor, teacher, nurse, truck driver, relied on both to keep retirement funds safe. If any one link failed, the entire chain trembled. That dependence worried even people inside the firm. What if Aladdin went offline? What if a cyber attack corrupted its data? What if regulators turned against the model that made passive investing so powerful? No company could process that much money without also carrying that much risk. And yet, the paradox continued to feed itself. Every crisis strengthened the machine. Every shock drove more investors towards safety, and safety, by definition, meant BlackRock. When markets panic, money moves to the biggest balance sheet. In the 21st century, that balance sheet belonged to Larry Fink. By now, Fink had become a fixture in world leadership circles. He met with presidents, prime ministers, and central bankers. His letters were studied like policy documents. He spoke at climate summits and economic forums not as a guest, but as a participant. He didn't hold office, but he didn't need to. When you manage $10 trillion, access is automatic. Yet in interviews, he seemed almost uncomfortable with the mythology. He often said the same line: "We are not the problem. We are a mirror of capitalism." If BlackRock owned the world, it was only because the world had given it money to manage. To him, the firm's power was a reflection of the system's design, not its corruption. But reflections can still shape reality. Consider this: 3 companies, BlackRock, Vanguard, and State Street, now control around 20% of the average S&P 500 firm. They often vote on opposite sides of the same decisions, effectively debating with themselves. It's efficient, yes. But if capitalism relies on competition, how free is a market where the same few shareholders own everyone? Fink's answer was governance reform. He introduced voting choice, allowing big institutions to cast their own votes instead of relying on BlackRock. It was a clever move, sharing responsibility without losing influence. To critics, it was cosmetic. To supporters, it was progress. To Fink, it was evolution. Even as he reformed, the empire kept expanding into new frontiers: data centers, renewable energy, private credit, even artificial intelligence. BlackRock wasn't content managing assets. It wanted to manage information about those assets. Its acquisitions in analytics and fintech turned Aladdin from a financial tool into a full-spectrum platform for decision-making. In a sense, BlackRock had moved beyond money. It was managing reality itself, how value is defined, measured, and moved. But value without humanity can feel cold. Fink, now in his 70s, often speaks about legacy. He talks about the responsibility that comes with scale, the need to make capitalism work for more people. He insists he's not chasing power, only stability. Yet the line between stability and control is thin. When one company can influence governments, housing markets, and climate policy simultaneously, stability becomes indistinguishable from authority. To understand BlackRock's paradox, you have to step back. Every innovation that made it dominant, automation, data, globalization, was designed to reduce human error. And it did. But it also reduced human agency. The system became so efficient that it left little room for anything else. Investors stopped choosing. Algorithms did it for them. Traders stopped guessing. Models told them what to do. The market stopped breathing. It started calculating. Larry Fink didn't create that world alone, but he embodied it perfectly. A man who believes that if you can measure everything, you can control everything. It's an idea as seductive as it is dangerous. Because what happens when the measurements are wrong? What happens when a variable appears that no algorithm can predict? History suggests it's not a matter of if, but when. For now, the machine keeps humming, the graphs keep updating, the algorithms keep optimizing, and the world keeps trusting the system because it hasn't failed. Yet. But power built on trust is still power, and trust can vanish faster than money. If another crash comes, and it will, people will look again to the quiet man in the dark suit, the one whose company seems to appear in every corner of the economy. They'll call Larry Fink, because when everything else stops working, his machine still does. He never asked for votes. He never marched in campaigns. He never seized anything by force. He simply managed risk better than anyone else, and in doing so became the architect of a new kind of empire. Money used to equal power. Now, managing money equals power. Larry Fink turned risk into an algorithm, and the algorithm into authority. Whether that makes him capitalism, its greatest innovator, or its most dangerous concentration of influence, is a question for the future. But one truth already stands. As long as trillions move through BlackRock's systems, the boundary between markets and governments, profit and policy, will remain forever blurred. The world runs on code now, and somewhere, in a server farm lit by cold white light, that code still whispers the same promise that built an empire. No surprises. If you found this story eye-opening, hit like, subscribe for more deep dives into money and power, and turn on the bell, because the next story might just change how you see the world's economy forever.